Welcome to Real Estate Live, where your questions get answered. We get to the point of the hot topics that everyone is talking about 3 times a week at 9 a.m. Pacific time on Monday, Wednesday, Friday on YouTube and Facebook Live. I'm your host, Andrew Finney with King Realty Group in beautiful Las Vegas, Nevada. Today's hot topic is about jumbo loan changes. To tell us more about jumbo loans is Bill Marin with New American Funding and special guest Addison Nett with Finance of America. They'll also give us the mortgage rates trend and mortgage market updates for today. After the hot topic, then we'll jump right into the viewer Q&A session. And joining us today is another special guest. And I'd like to give a big shout out to Ben Guava for reaching out to me on YouTube, Facebook, and Facebook Messenger to request today's special guest, which is Jesse Dow with Living in Portland. He founded the YouTube channel Living in Portland. It is awesome, and we'll have Jesse on to tell us more about that in a bit. To ask a question, please use the chat box. If for some reason we miss your question, please hit us up in the comment section so we can get them answered for you. And why don't we go ahead and bring the gentleman on so that you can meet Addie, Bill, and Jesse. Good morning, gentlemen. Is everybody up?
Oh yeah, live and well. Got my coffee right here.
Boom, boom,
Hey,
boom.
you gotta have
my juice. Good morning, guys.
Well, fantastic. Well, gentlemen, I know it's really awesome. And Jesse, thank you for joining us. Addie, thank you for joining us. You're both out of Portland, Oregon. So thank you so much for being here today. And Bill's in Las Vegas, of course. Why don't we start off with like the mortgage rates and go ahead and just hop right into it and talk about today's mortgage rates, the mortgage market updates, and then we'll get into the hot topic. So what are we seeing with the mortgage rate trends right now?
So Andrew, just the same as last week. I mean, it's been relatively up and down. This last week it was relatively stable towards the end of the week. And same thing, the way the market opened up this morning was a little bit on the weaker end, but today it opened up good. Still getting a recommendation to kind of float these interest rates on purchases if you're not closing within 30 days. There's a lot of economic data coming out this week, all tied to real estate. So should be a good week for that. And we're thinking it's going to do good for rates as well. So again, just if you're not closing within 30 days, go ahead and float. Always, if you qualify now, if you do qualify with the rate that your lender is quoting you, please lock in your interest rate if you're closing within 30 days, because there could be a swing that you're not prepared for. So the guidelines, I know, Andrew, I did several conference calls last week, and we talked a lot. We didn't have many changes last week. We're kind of seeing things kind of settle down a bit. There hasn't been many changes on our end. There has been little tweaks here and there. But relatively consistent. I know every lender is different, so I'm excited to have Addie on this call and kind of see what we're seeing elsewhere in other markets and then other companies too.
Yeah, Bill, that was an awesome intro and update there on the rates. And I think the only thing to add to your amazing explanation there would be really get with your loan officer, your mortgage broker, whoever you're working with, because there's so much going on specific to the company that your loan officer is working for. And that's not only guideline specific, guys, that's rate specific. So you might see some lenders out there who did not do a very good job when we were going no huddle offense when COVID-19 hit, and they're struggling and they're looking to make up margin. So I highly recommend being hyper communicative with your loan officer. Get refreshed rates every 24, 48 hours. Have them build out a spreadsheet and an updated loan estimate before putting in an offer. Because if you were talking to your loan officer last Thursday and you put an offer in on Sunday, something might have changed Friday and Monday that could severely affect your monthly payment and cash to close.
Yeah, definitely. Good points, man.
That was an awesome expression there, Addie. And I got to circle back on it. You said a no huddle offense. What does that mean when a lender says a no huddle offense, my friend? I just love them.
Yeah, well, I think, everybody is sitting here now and it's like, okay, we've been home for X amount of weeks or whatnot. But I'm thinking back to when rates were starting to drop. The stock market was having a ton of volatility, which were affecting interest rates, and what that was like when I was in my office. I'm physically at my home office now, but what was my company doing and how are they reacting to it? Are they locking rates left and right? Are they locking 15, 30-day rates when there's 45-day closes? Are they overextending their line of credit to fund loans? And there's so much going on in this. It's called the secondary market, when your loan actually gets funded and then portfolioed or sold. that even I've had to learn and self-educate and dig so I understand what's going on. So the no huddle offense was like, everyone was like, oh my gosh, I saw a 350% increase in refi applications in 10 days. I took a 2 back-to-back Zoom calls when this all started, and I looked at my inbox and I had 9 applications in 2 hours, and I didn't know who any of them were. No idea.
Wow.
And compliantly, I have to work the application, disclose, and then I have certain service standards for myself where, I want to connect with them on a Zoom call. I want to give them the full walkthrough, everything, the 5-meal course. So it was very no huddle there for everyone's just like, we got to work these applications. We got to do this, frantic. People didn't know if they're keeping their jobs. So that's what I mean by the no huddle offense.
Love it. Pivot and move. Stay flexible and adaptable, right? So, gentlemen, this is the hot topic now that we want to go into. And when we're talking about jumbo loan changes, I think that it would be best to first define what is a jumbo loan so that anyone that's wondering what the heck is it to begin with, then we at least have a frame of reference before we start getting into the particulars. So one of you two gentlemen, Bill, Addie, please define what is a jumbo loan, please.
So a jumbo loan, Andrew, is any loan amount that's over in our cities and states right now, $510,400. So any loan amount that's over that, you can have a purchase price that is over that, but if you make a down payment to a substantial amount to where it takes that loan amount below, you still would fall in normal conforming guidelines. But any loan amount $1 over $510,400 would be considered a jumbo loan. So that's in a nutshell what it is.
Okay. Anything that you want to piggyback on that, Addie?
Yeah, I would. The great explanation. I would say some of the common scenarios that we see, at least up here, Jesse and I, in the Portland market, is there's a lot of attractive homes in that 525 to 600 price point. So when you're backed up at a 510 conventional loan cap, you as a buyer essentially need to bring the difference, right? So if it's 600, you got to bring 90K rounding down there. And not everybody has that. So when jumbo loans are in the mix, it's a little bit more challenging now. And we'll dive into this, the changes in getting approved for those loans. So it could be a huge difference between being able to do 10% down versus bringing 90 grand. So a 30 grand swing in that 600K listing scenario.
Fantastic. So that'll take us right into the jumbo loan changes. Bill, I know this is something that you've asked me about the live stream for at least the last 2 to 3 weeks because there's been a lot of movement and it affects a lot of buyers in the market. So why don't you lead in, and then Addie can also jump in with his lending insights on the jumbo loan changes as well.
Awesome. And I know our different states will be different as well, with different guidelines and things that we can do. But one thing before we even jump into the jumbo guidelines, Andrew, I want to just mention and reiterate again, I know we've talked about it before, but veterans right now have an opportunity with the changes that recently happened with VA loans is you can essentially qualify for what you qualify for without having to come in with a massive down payment. And you avoid having to go through the whole jumbo additional guidelines and overlays and things that come with that and additional requirements. So if there's a veteran out there that's looking at those, like Addie was saying, those price of homes, because there's some pretty sweet properties in the 600 to $1 million price point. And you can come in as a veteran and literally buy that home with no down payment, obviously covering closing costs, whatever happens in that particular scenario. But VA is still some options to avoid jumbo. Now on the guideline side, man, like Addie was saying, I love that analogy, man, the no huddle offense. That was literally what was happening, especially in the jumbo world, man. And we're deep into that here in Vegas. And it's one of those things to where it's every day there's been changes with what's been going on. And it's not that there's, no more jumbo loans. Like I've seen it out there. So, oh my God, jumbo loans are gone. Not the case at all. There is jumbo loans that are still available right now. And again, Addie, when I'm done that jump in, let me know anything that you guys have that's a little bit different, but we can still do jumbo loans with 20% down kind of across the board. Some of our avenues of getting those done are not available anymore. Some of those loan programs are gone, but we still have several options for 20% down. We also have jumbo loan programs with a bank statement program. So that is still available as well for self-employed buyers. And then something that Addie kind of had mentioned is there is that sweet point price, man, between, 510, 600, 650, maybe up to 800,000. to where we do a lot of first and seconds, to where a buyer can still qualify for the normal conventional guidelines. And if it's possible to do that, highly recommended. You can still qualify for the normal conventional guidelines with a maximum loan amount of $510,400 on the first. And then the second would be either a home equity line of credit with an interest only period for the first 10 years and then fully amortized for 20 years after that, or just a full fixed rate second. So those are really good options in those price points like we were talking about for buyers to avoid a lot of the jumbo kind of guidelines and things that you might run up against. And they can qualify with as little as 5% down for that. So again, if you're in that market and people are looking in the jumbo market, just like Addie had mentioned, I know Andrew, you and I have been talking about it, call your lender, call your lender because they're a resource for you, but also call your real estate professional and find out, if the lender that they recommended you work with or the one that you're already working with doesn't have those options. You want to check with your professional real estate partner that you're working with, your real estate agent, and see if there is another lender they know that has more options. Because again, the lender that had it a month ago or 3 weeks ago or a week ago may not today. So communication is freaking key to just make sure that that program is still available.
Yeah, that's super, super well said. And there's a couple different buckets I want to dive a little bit into there. One being back to the jumbo situation and then hitting that 1-2 option on the first and the second. So just the jumbo, I think one thing to note, and people need to be very, very, very understanding that the guidelines are extremely different on jumbo loans right now. And meaning guidelines being like, what's a guideline, right? So just the basic person watching out there that doesn't talk about loans all day long, because Bill and I will get off at tangents and start talking about things and everyone's just like glazed over, like, huh? So
I'm glazed.
Right? So we do this all the time. So bringing it back down to some like take home points, like, yes, there's still jumbo loans. Yes, you need to get with your loan officer. On my end, Bill, what I'm seeing is the reserve requirement to qualify for those jumbo loans has changed significantly. So what is a reserve? A reserve being essentially how many months do you have in the bank for your mortgage so that if anything happened, the world stopped, you lost your job, you had no more income or cash flow coming in, could you keep making that mortgage payment until you run out of money? So basically in like FHA or a conventional loan, it strengthens the buyer's file by having 1 or 2 months reserves. Now in the jumbo world, we were seeing maybe 3 to 6 months pre-COVID-19. I've heard anywhere from 6 to 12 to 18 months, depending on the investor. And then to top it off, to put another layer to the freaking cake here, is there's sub guidelines on where those reserves came from and how they're valued, because not everyone has it under their mattress or in their checking account. So people are pulling up all their IRA, their 401, their money market account, and all of those have different value requirements and like equations to determine from an underwriter standpoint if those funds make the reserve requirements.
Yeah. And have you seen that? And I know I've seen it with a couple different investors to where somebody might have $400,000 in a 401k, but they might need 25,000 or 30,000 extra in reserves. There's some investors out there that are requiring that to be actually liquidated, meaning, it can't just be chilling in your account. You got to liquidate it, put it in your savings account, do the paper trail, and then we got to see that it's there liquid. So definitely something that's different.
I've seen that as well. And then to go to your 1-2, Bill, we did a whole episode on this with Ed Schwartz from Symmetry Lending, who specializes in the second. Love Ed. Everyone loves Ed in the United States. He's a great guy. That is a great move. And one thing to note there, so there would be 2 loans. So back to like people who don't talk about this all day. The first one would be your max loan amount of $510,400, and then you would borrow the bridge. So you can actually do a 10% down over conventional cap listing. So say it was 700 grand. If you did 10% down, 70 grand, the difference between the 510 and that bridge from the 10% down would be your second. So there would be 2 mortgages. And to your point, yes, you could do an interest only, you'd have that option, or a fully 20-year amortized second loan. And I'm seeing the rate be like 1.25 to 1.5 more than the first interest. So it is a little bit of a higher interest rate. And I got the compliance things. There's tons of like, consult with your loan officer. This isn't a commitment to lend, all that nonsense. We're trying to be very transparent. You know?
So with the 1-2, is the buyer going to get a better benefit for using 2 loans versus just one jumbo loan?
Well, you wouldn't have the requirements like you would to a jumbo loan with the reserves. You would be stuck to the first guidelines. So significantly less reserves, and maybe Bill could add to that. I don't want to take the stage too much. I ramble.
No, man, that's good, dude. So I mean,
you guys are loan officers. Loan officers always ramble.
We do.
I don't know about Jesse, but I kind of think they just always ramble too.
I was just asking, like, for the viewers out there, is there like a substantial benefit to doing 2 mortgages? If somebody could just qualify for 1 jumbo loan, would it be beneficial for them to do the 1-2 versus the single jumbo? Or
I would compare, because every situation is going to be different. You know, every credit score is going to be different. The lender that's doing the first, their guidelines might be different. Like, I know Finance of America is very similar to us. Our guidelines are pretty straightforward. We don't have a lot of overlays. Our rates are smoking. So it might make more sense to do a first and a second, but I would compare both just to see what their options are. The rate is definitely higher because you got the prime rate. Plus, I was just looking at Symmetry's rates with their 5% down program. It's, you know, from 720 credit score to 759. Essentially, it's prime plus 3.25. You know, so the rate's going to be up there, but it's a good option if they choose to go that route. If they don't have a full 20% down, it's a great option. You know, if you have 20% down, I would probably stick with just a regular jumbo loan.
I wanted to hop in really quick to Jesse's, the 2 benefits to Jesse. And I've had different scenarios where the second can be structured where it's a line of credit. So if you're paying it off, say your second is 150 and you pay off 50 grand of it, you still have 50 grand as a line of credit. So say you want to do some stuff to the house, say you want to have access for paying whatever bills or this or that or projects. It doesn't just go away like a traditional mortgage. So it could act as a line of credit. And then secondly, and this is a common scenario that I saw a lot last year, is say you're inheriting money and you don't quite have it yet. Say, you know, it's coming in 3, 6, 9, 12 months. You got $250,000 coming, you take that second out at 200 grand, you get the money in a couple of months, and then you can pay that off with your inheritance. So that way you get the rates on the conventional, and then your second gets paid off with literally like a very low cost bridge loan if you're in that situation. And you're seeing jumbo rates not nearly as comparable as conventional loans on a national perspective. If you look at Mortgage Daily News, we're in the low 3s nationally for tier 1 solid down payment on conventional, and almost a full percentage point on jumbo, which, man, 3 months ago, they were lower than conventional. So
it was opposite.
In some situations, you're going to lock down a way better interest rate for 30 years doing the 1-2.
Yeah, I think a lot of viewers, even myself, like going through the mortgage crisis of 06, there was a lot of the 1-2s out there with low guidelines. I was actually looking at the index for borrowing money yesterday, and it was crazy how much easier it was to get a loan back then. It was like 8 times less guidelines. But so I think when people hear 1-2, like 2 loans, they're automatically going to assume that it's going to be like more money or there's something weird going on here. But just based on all of our clients that are doing it, I've only had one client get a 1 full jumbo loan in the last 2 years. Most people do the 1-2. So it's a very common and normal thing.
Yep, definitely.
Fantastic.
That's good to hear. I'm glad you guys are doing the same thing we've been doing down here.
Fantastic, gentlemen. I really appreciate all of your keen insights in today's hot topic about jumbo loans. What I'd like to do is move on. And for everyone that's joining us now live and everyone that joins us after this live streams and watching it in recorded format, thank you for being here. Greatly appreciate you joining in. Just as a quick reminder, to ask a question while we're live, please use the chat box, or simply post your question to the comment section if for some reason you miss it. Now, Ben Guava is somebody that watches a live stream. I hope that Ben is here with us today because he asked to make sure that Jesse and Addie came on today. So I would definitely like to put up Mr. Jesse's information here in a moment so that everybody can see it. He does have a YouTube channel of his own. called Living in Portland, Oregon, where they make a lot of excellent videos. So if you've ever wondered about Portland, Oregon, all you have to do is go over to Jesse's channel and take a look. And if you'd like to follow Jesse, you can also follow him on Instagram. Very easy, Jesse YouTube Realtor. And if you want to see what homes look like in Portland, Oregon, you can hit up his website, livinginportlandoregon.com. All the links are in the show more description. So, Jesse, thank you so much for joining us today. It is great to have you. Why don't we see if we can jump into some questions that are coming in from our community, and we'll take it from there in the viewer Q&A session. So we have Meseret Binti. Meseret Binti says, good morning. I am not a morning person, but I put an alarm next to me to wake up that I don't miss it. Hey, Meseret, love your commitment, my friend. You are a rock star, and please definitely get the word out about what we're doing. We are trying to help people make sense of real estate and lending and keep track of all the crazy changes coming down range. So Meseret, good morning, sir. I'm glad that you're here. Maybe we'll make you a morning person, right? And start setting up some different habits here. Kathy Martinelli says, good morning, everyone. Kathy, thank you again for being here, my friend. It is great to hear from you. Pug Love in April says, good morning, everyone. Pug Love in April, thank you. Just a quick heads up, on Wednesday, we will have JP Flewellen out of Cheyenne, Wyoming on with us. So that was your request of me last week. I want to let you know we made good, and JP Flewellen will be joining us Wednesday from the Wyoming marketplace. Koa Lee says, thank you, Andrew, and the speakers. Koa Lee, definitely appreciate your support. It is a tremendous opportunity to have both Jesse Dow and Addie Nett on with us today, and I'm super happy that they're here. Anthony Laborde says, all-star team. Thank you so much. So, Jesse, is that one of the people that you know too?
Yeah, I know Anthony. He's actually over at our brokerage out of the Phoenix area, I believe.
Fantastic. I was pretty sure. I saw that all-star team and I thought, hey, we got another Ben Guava on with us today.
He's actually in our YouTube agents program as well.
Oh, fantastic. And your YouTube. Yeah, you did tell me that you and Jackson Wilkie do some stuff to help out agents with YouTube. And that's pretty cool. So yeah, that'll have to be for a future topic, right, Jesse?
Absolutely. Yep.
Rafael Flores says, good morning, gentlemen. Good morning, Rafael. And thank you for being here with us, my friend. And Rafael wanted to give us a quick update, says that he got moved into his new home on April 13th, all moved in. Thank you for the guidance during my 45-day escrow. I'm super happy that we were able to help you out, Rafael. That's what this is all about. Now, my friend, turn over to on my YouTube channel, the home ownership playlist, and start boning up on home ownership. There are over 50 videos there just waiting for you to go through at your convenience. Kyle Walker. Now, here we go. This is going to go into you lenders. Kyle Walker says, this is wonderful timing. I'm glad it is, Kyle. Currently in the situation with an FHA loan, the bank is requiring 6 months of reserves.
So, yeah, again, communication is key. These guidelines are changing all the time. Some lenders put it out there a couple weeks ago that everyone was going to require 6 months across the board. If you were furloughed, we could still close. That's just not the case anymore. It's changed again. So if somebody is furloughed, currently not working, not getting paid, we can no longer do the transaction, which makes sense because we don't know when they're going to go back to work. Again, some lenders will have an overlay, which is a guideline like we talked about before, which is the basic rules for doing a loan. And then an additional rule of what some lenders are going to require is 6 months of those reserves, or 6 months of what it actually takes you to make your mortgage payment. So if you have those 6 months of reserves, rock on, awesome, go through with it. If you don't, again, reach out to a real estate professional and see if they have another option for you, and just someone else to talk to see if you have a different, maybe a different avenue you could go down.
Yeah.
How do you got anything to add there?
Yeah, I want to add in real quick that with the reserves too, those can't be gift funds. So bringing it back to people, because that's probably the first thing. If I was just not in the industry, it's like, well, I'll have daddy or mommy send me over whatever. It's like, doesn't work. So in some situations, if you painted yourself into a corner here with some guidelines and reserves, get with your loan officer and talk about maybe adding on a non-occupant co-borrower. And it's a short-term solution with a long-term goal of removing that perhaps family member from the loan, but you could still close. So don't give up. keep communicating with your loan officer. And I know it's frustrating, but we got to come back collectively in the industry here. And to Jesse's point earlier, is like everyone's kind of afraid of 2008 and it was so easy. Is this the crash or whatever? These are great steps that are preventing us from making horrible approval decisions in a very crisis-based condition of the United States. So these are all really good things, and adding on a non-occupant co-borrower holds just another person accountable that mortgage payment is going to be done. It's not free money getting wheelbarrowed around. We all know that. So just a few points there.
So did you see that Kyle also piggybacked his initial comment with, hey, we found out that we were approved for FHE loan, but now they want to confirm 3-year payments for student loans. Any advice on income-driven repayment for student loans? They recertify on a yearly basis. Great question, Kyle.
Addy, take it away, man.
Yeah, man, I haven't even ran into that. It's a 3-year continuance on. So what I'm trying to think in my head, because this is probably an overlay. So the student loan balance is probably income-based repayment, meaning there's no sort of financing structure to pay off that debt. So the first thing I would look at, because normally the default use is 1% of the balance has to be hit against the liability within the file. So bringing it back down to just normal, say you've got $100,000 in student loan debt and you haven't amortized that out, you're going to be hit for essentially $1,000 payment on your approval amount, decreasing what you can buy and what your buying power is. So this, what seems to me like maybe a 3-year continuance, I don't know, some way to at least pay the estimated balance owed over 3 years. I'm not sure. The only reason why seems like there's so many of these overlays in this particular situation might be a pretty low credit score. So if you're under like 660, I would say 640, you start getting pretty low, because FHA has a standard 580 is a normal low credit score. So that 580 to 620 kind of seems like, I hate to use this word, but I can't come up with something better, the danger zone right now. So it's like, how do we put this applicant, how do we approve them, but approve them to be successful, right? So they don't want you to get keys in hand and then completely default on the mortgage and go into foreclosure. So I think it might be a lower credit score. This seems like a very stringed along way to do it. Once again, I would go back to the loan officer and look at any family members that could be a non-occupying co-borrower, because a lot of those overlays might even change or be not as heavy if there's another applicant on there. Bill, anything? I'm trying to put together an answer really hard, but it's tough, as you know, without a file and a credit report and all that stuff.
Yeah, no, I think you hit the nail on the head, man, because that's got to be it's either just straight overlays or, it's going to be a low credit score. I think more than it could be a big bank. I know here in Vegas, we've seen a couple of credit unions really, really tighten up the guidelines to start just asking for just some crazy things to get the loan done. So your advice, Addy, was great. Talk to that loan officer and find out, Kyle, what's going on, what they really need, and see what you can do to come up with a solution, because that's very unusual to ask for a 3-year continuance or a 3-year history of making student loan payments. It's very weird.
Solid advice, gentlemen, solid advice. And Kyle then piggybacked and said the potential co-borrower is a wonderful advice. He did appreciate that. So thank you for throwing it out there. And he said that they should be okay, but just in case, it's a wonderful solution to help them be able to close on their new home. So that's amazing. So I want to go ahead and jump. I was reading the comment that made me laugh. Oh, okay. Well, yeah, we see all the comments coming up. So, I mean, keep hitting us up in the comment section. We want to make sure that all of your questions get answered today about jumbo loans or loans in general, especially having two powerhouse loan officers on. If you have questions about Portland, Oregon real estate, Mr. Dow, Jesse Dow, Living in Portland channel on YouTube. I mean, we're all here ready to make things happen. Claudia Alexa says, thanks, guys. Well, Claudia, thank you so much for joining me and us today. Carrie Stringfellow asked a really good question. So lots of loan questions. I'm glad that we're getting hit today, Jess, with so many loan questions, and we got the backing of two amazing loan officers with us.
About 90% of our live show content is always loan officers. This is why I have Addy on every single Zoom call with us with our clients, because it's never a real estate question, which I understand. And that's why we have a partnership with the great loan officers, right?
Absolutely. So Gary Stringfellow, gentleman, is asking what is going to be the LTV limits, loan to value limits? In other words, for everyone wondering what that is, LTV is loan to value. What is going to be the loan to value limits for a loan of 1 million or greater?
So as of right now, with that whole COVID-19 situation, what we're seeing is 20% down. So 80% loan to value, 20% down payment. What we're seeing in that price point currently is where you're at now. In the coming months, when things potentially get back to normal towards the end of summer, maybe into the fall and winter, that could change. That could come back to the normal 10% down jumbo stuff that we had before. But as of right now, what we're seeing across the country is 20% down, 80% being your maximum loan to value. So, Addy, you got anything to add?
Yeah,
what you guys are seeing
on the 1-2, say you bypass the jumbo and you did the 1-2, you had $1 million sale. You could, you could go 10% down. So, 100 grand there minus 900 minus what? The max conventional 510. Your second would be 390 right there. So you could go 10% down. You'd have a first at 510 and your second would be 390 amortized over 20 years if you wanted to have the lowest payment possible on the second. So you could do a 10% down million in that situation, but then you'd be referring to combined LTV. So that would be a 1-2, just to clarify. So 20% down. Yeah, I'm seeing that too, Bill, with the jumbos that high. But once again, you're going to have a ton of those overlays per investor, per bank, which has been, and we didn't even hit on this credit score. Like they're not wanting 680 jumbo loan credit scores. What they want, top tier people with tons of money in the bank, tons, over a year liquid, like just to put it out there generally. So the 1-2, you could qualify on the conventional guidelines. Bring out the second there and go as low as 10% down. You had mentioned something about a 5% down, but I haven't structured a 5% down 1-2, just a 10.
That's Symmetry. You mentioned Symmetry. Symmetry is the 5% down option that we have. They allow to go to 5%, and you just mentioned the 1 million with the 10% down, which is great. I didn't realize Symmetry allowed you to go up to a $500,000 line. For a primary home, which is awesome. So that's huge. But so Carrie, there is some options. Addy, thanks for showing me that, man, with the a line amount up to 500K, which is great. But once you get over that, you said greater than $1 million, I think is where you'll start having some issues with putting down less than 20%.
Oh, yeah.
So Bill, I do want to piggyback something because you've been telling me about VA loan changes, right? So let's say that Carrie was a veteran or is active duty, right? Using a VA home loan, and there's now the VA jumbo loan product that is zeroed down to essentially any capacity from the way it sounds to me, so long as you obviously qualify debt to income ratios, income. I guess if you were like a 4-star general, I mean, it might work out pretty good if you were buying a multi-million-dollar property. But at the end of the day, there are veterans and active duty. I've seen both enlisted and officers that have some side hustles going on that they make a massive amount of money on, and maybe they want to do that. So the question that comes to my mind is that something that would be an option for like essentially a zero loan to value on a VA jumbo home loan product?
So so that's a really good question because we're getting a lot of that recently. It would be 100% loan to value, no down payment. Just remember, you still have to pay for closing costs, or someone does, whether it's the seller, the agent, or the buyer paying for all of it on their own. As long as the buyer qualifies, as long as the veteran qualifies or the active duty person qualifies for the payment, then absolutely, VA is a great option. I haven't personally seen those large loan amounts for active duty personnel, active duty military. Have not seen that. I've seen a lot of it in the veteran world. A lot of us veterans go out there, and there is opportunity for that. I guess where it would make sense for an active duty person is, like you said, like you mentioned, and if it's an officer, maybe a married couple, both officers making great income, or maybe the active duty member's spouse is got extra income coming in. That's a great option to go above $1 million and not have to come in with a down payment, and you still follow the normal VA, what we call high balance guidelines. That's over that 510 400. So a little bit stricter on credit scores, but still a phenomenal program.
Thank you for that. And Addy, have you seen or have you structured any of those in Portland?
Yeah, so I've structured them. I haven't closed them. So here are a couple of my notes on the takeaway of VA, because one thing I think a lot of people don't understand is when you exceed the 5, 10, 400, which is that standard cap, there is a different pricing model I've noticed, not only on my side, but other investors and other lenders. So you're not getting the same rate. And, you know, I was going through this with Jesse a couple months ago where we had a great person who was like, hey, you know, my financial advisor, his lender is offering this promo rate, right? And the rate was crazy, like awesome. 3.6, 3.7, something like that. And I'm looking at it and looking at their price point, and I was running the pricing at a VA loan above 510, 400, and there was a huge swing. So it's what I've noticed is the VA loans that are exceeding 510, 400 are being priced more like jumbos, like a full percentage higher. So just because you're seeing some sort of ad out there from Costco freaking mortgage that it's 2.5 does not mean you can get $1 million VA loan at 2.5%. So you got to be like, you got to communicate, and you can't assume. And Andrew, we were talking about this before we hopped on. There's so much clickbait out there, and it's unfortunate. You know, I think everybody here is leading with transparency and the intention of educating and hopefully opening a door for someone to have access to true information that can guide them through the process. But do not trust a banner ad. Do not trust something on a billboard or something you clicked into. All they want you to do is fill out a freaking form and get you through their funnel. So I'm sorry, I get really passionate about that.
No, I think all of us get really passionate about that. And I think that's what makes this such a strong dynamic, and something that I'm looking for with the agents and loan officers that join us in future live streams, obviously, is to increase that. Now, I did want to say something because I didn't have the information ready to go this morning, and my apology for that, Addie. But from my understanding and having a really robust conversation with Jesse last week is that you also have a podcast that is more or less designed to incorporate essentially what I'm doing, but in your podcast with loan officers as opposed to real estate agents, where that's what I'm looking to do is shed real estate perspective, and another lender wants to come on, I'm all for it. But that said, could you give us the name of your podcast and where it could be found, please?
Yeah, no, I appreciate that. And it's called The Modern Loan Officer, short MLO. So that can be found on Apple Podcasts or Spotify right now. And then you can, the last 8 episodes have all been live streaming converted into podcasts. So we live stream on Facebook, MLO Podcast. So you can check that out. We've got a great team, and, you know, it's been fantastic to have Jesse and Jackson assist with kind of building out the infrastructure, because they really built the groundwork with the YouTube channel and driving technology. And man, I couldn't believe a year and a half ago, you know, we're all standing in a park with GoPros and be like, what do we do here? And then all of a sudden we're trying about bit rates and stream frequencies and audio quality, and like, you know, I can't cast out to my 7 groups and I'm frustrated and blah, blah, blah. So I
think that's something that all of us as creators go through. I mean, I was looking at Jesse's channel, and, you know, he has some content up, and I was thinking, my God, I got started with a webcam and the built-in mic. Didn't know what the heck I was doing. All I knew is that I had the passion to try to help. And I was so amused when I got one of these and then a real webcam. And now I'm onwards and upwards to like 4K cameras. And, you know, I have like all kinds of cameras now. So, and I'm still working on, to your point, like bitrate, codecs, you know, how do you do this? How do you do that? Angles, maneuvers, learning right now the ninja walk, as they call it, for shooting with a gimbal. So, yeah, I mean, it's so much fun, but it's not just like here with real estate and lenders that we go through this. I think this is an education curve. Anybody that aspires to be a creator and truly help people and actually create that engaging content, we at some point have to get away from a simple GoPro style or a cell phone style into a main content and use it as ancillary components to a video. I mean, when you start talking about that, we could go into like a tech channel all of a sudden and start having a conversation. So I'll shy away from nerding out too much, but I understand everything you just said, and that's why I was laughing. So I applaud you, Jesse, and your commitment and getting it going, because your quality of your thumbnails and videos and stuff right now are like freaking amazing, especially where you got started compared to how I got started 4 years ago with the videos. I really like your quality.
Well, I have a huge suggestion. Like and what Jackson and Jesse have done, and it's not only a financial commitment, but a time investment. It's unreal. I've been shoulder to shoulder with these guys, not only as friends, but, you know, business partners and growing. And get with Jesse and Jackson and learn how to adapt. There's no better time right now. If you're, you know, wanting to learn about real estate, you're wanting to learn about buy a home, like, you know, the person who was like, I'm not a morning person. Well, what's great is all this stuff gets posted post live. So go in and watch, and free education, get in with the network like Andrews and Bill's. And Ben's a great example. Like, he's so tied in and has made so many digital relationships that eventually will come back to face here. But yeah, it's fun times.
Well, the thing that I love too, it's like, you know, before this whole COVID-19 thing hit, like no one, like we've been doing Zoom for over a year, and it's been our favorite platform in the world. And, you know, cause it's really hard. And, you know, Bill knows it's like, you know, your real estate agent tries to set up a buyer's consultation, and, you know, it's hard for them to like get childcare or take time off work or getting everybody in the same room. Well, this allows us to all do it from our office or home, which is really nice. And it really breaks the ice, because right now, before the world of Zoom and, you know, live stream and all that, you know, more and more agents and lenders are taking advantage of. It's like the only thing that you get to do is go onto Google, find information that could be outdated. But now with things changing on a daily basis, it's great to provide that, you know, up-to-date driven information, which I think is very important to help people make, you know, educated decisions. Because I know we get a lot of people that, you know, talk trash and trolls on our channel, which is totally expected, you know, but a lot of people consistently reference the economical crash. And I really think like what we're fortunate for is that the, you know, the federal regulations are really preventing us from going into another crash. And I couldn't be more thankful for the tightening up of guidelines. And sometimes it is a pain in the butt, but at the end of the day, like, you know, we don't want to ever see what happen again. And it's also about educating people of like exactly like what the difference between this time period is versus that time period. And the only way you can do that is really with, you know, up-to-date live information and facts. And that's what we try to provide, is just factual data to let them make the best decisions possible.
That makes sense. And that's why, and to your point, I love it. And I love the fact that we have this, as the gentleman earlier, Anthony, had said, all-star team. So when I got started in the videos 4 years ago, since then I've cranked out over 600 and pretty close to 650 videos, including reality shows of showing the home selling and home buying process through the real process. And Bill and I were using video formats from Zoom to Facebook Messenger to BombBomb, like 4 or 5 years ago. So we've been doing the video thing for years. Even then, Bill, back then, whenever he and I got started, he sent me this one thing off of his phone. It was like a little MP4 clip. He's like, dude, tell me what you think of this. I just sent it to one of our clients that closed. And I mean, before the services even existed, we were like, hey, we're trying to make this a more personal connection because we care. Like, and I think that's what it comes down. And that's why I think these live stream formats, to your point, things are moving so quick. To what Addie said earlier, they need people need transparency, they need honesty, and I'm not big on clickbait. What I am big on is truth, integrity, and doing the right thing. And I believe sooner or later, this type of platform, this type of a stream, this type of a show gets found. And by working with you and other great agents like Angie Cole last Monday, that also has a podcast, learning that Addie has a podcast. Jesse, you have the YouTube channel. It's like over 4,000 subscribers and growing. And what, you've been doing that for about 3 years now?
Oh, no, we just hit our 13th month mark on that.
Well, that's phenomenal growth. I mean, the over 18,600 subscribers on my channel has taken me 4 years and change. But in that first 13 months, Bill can remember, I think I was like hovering around 200 subscribers. And I was like all kinds of excited back then. I was like, oh man, we got 200 people watching and this is amazing, because it's not about like the number in as much as it's about the community. Oh, 100%. And that's why I like that Ben reached out and was that engaging on me to ask you to come on camera, because it really is about a community perspective. It's about understanding and aligning with the tribe that we have. And in my friend's words, Sean Canal at Think Media, he likes to say, your vibe attracts your tribe. And
Yeah.
I love that comment because it truly does. So that's why I think all of our vibe is forming this tribe, and we're presenting the value to our tribes on our YouTube channel and podcasts, etc. Anyways, I get really excited about this stuff and the impact and potential impact that this can make to people as they watch and as they share the content around, and people start taking notice. Hey, this is what's going down. So thank you both. Thank you for being here. Megorium, I see you, Megorium. Of course, I got to give you some love because Megorium is here like all the time again, and it's great to see you, my friend. And she says, good morning. Pug Love in April, I know what this is in regards to. You said wonderful. You're referring to JP Fluellen, who will be on with us on Wednesday's live stream from Cheyenne, Wyoming. You're very welcome, ma'am, and I appreciate you letting me know. So anybody watching right now or just joining in, if you'd like to see an agent from a specific state or a specific agent like Brian Guava, I said Brian Guava again, Ben Guava had asked me to get in touch with Jesse Dow and Addie Nett, let me know. I'm happy to do what I can to get people on the show and have a robust conversation. Kathy Martinelli says, thanks, Andrew. You are wonderful. You are wonderful too, as are each of the gentlemen on with us today. Y Hori says brain power in the house. Definitely brain power between everybody on the screen today. We have it going down. So Jaw G, thank you for being here, Jaw G. This is going to go back to our lending partners now. Jaw G says, thank you, Andrew, for the content. I couldn't do this without my partners on screen, Jaw G. So thank you again, gentlemen, for being here. And thank you for the question, Jaw G. Jaw G says, hey, you guys mentioned the stock market. Any thoughts on how current REIT's prices and how they affect mortgages? For reference, everyone watching, an REIT is a real estate investment trust. So he is asking how the stock market and current real estate investment trust prices and how they affect mortgages overall. Lending, gentlemen?
It's our favorite thing to talk about, right, Addison?
Jeez, yeah.
Oh, man. So if you guys are experts on that, I'll let you go away with it. But I wanted to really quickly mention that a lot of people are seeing these massive improvements that you see online. Like Addie was saying earlier, you see things advertised, you see, oh my gosh, rates dropped, rates went up. Just so everybody understands, that does not immediately affect your actual mortgage rates that your lenders have available to you. So that is something really important to understand, because we had that happen a lot in the last couple of weeks, to where we saw massive improvements in rates, but most lenders were not just immediately, that was not showing in their interest rates that you were able to lock in on your mortgages. So I'm not as familiar with the real estate and investments and trust. If Addie, if you guys are both familiar with that, definitely you guys chat about that, man. But yeah, the rates are definitely moving a lot in the last couple of weeks.
Yeah, well, I'm not a financial advisor licensed in talking about stock trading or whatnot, so I got to preface there. I'll give you my opinion on the stock market and try to break it down to at least a digestible 1-2 here. So normal market, traditionally, you would see people investing in future stocks like blue chip, Apple, tech, whatnot. So the more and more money that gets put on that side would affect more conservative investments such as U.S. treasuries or bonds or mortgage-backed securities. So when you would see everyone have their money in futures, then you would see the mortgage interest rates kind of go up because all the money is over there on the other side. And then when people get scared, it tips the other way. So they move from very positive thinking future investments to safer, like mortgage-backed securities, U.S. treasury bonds. That was the normal kind of balance, right? What has happened is nobody wanted their money in anything. They wanted it home in their little cradle or under their mattress, nowhere. So we've had this black hole period where oh my gosh, what's going on? So then the feds come in. It's hey, we're going to commit to buying mortgage-backed securities to drive home this industry. We're going to make access to lending for banks and businesses at 0% for those two categories, which hopefully are going to lower down interest rates. So you started to see this recovery and interest rates are starting to come back down. But we go back to that no huddle offense. We're starting and ending at that same term there. A lot of lenders made a huge amount of mistakes running through this, and they're holding on to a lot of loans that have zero profit in them due to bad operations, bad lock periods, and we don't have the time to break into that. But a lot of these loans, people got screaming deals. They're not making any money on them, if not losing a ton. So we are going to see a ripple effect probably in June, in my opinion. We're going to see a lot of companies folding or having to merge with bigger companies to stay afloat. So what does that bring to the consumer here? What that brings is inconsistent pricing from lender to lender, because certain companies might be in debt on the current loans that they're funding and need to make it up somehow to stay afloat. So how do they do that? They raise their interest rates, they raise their fees, and that hits the consumer. So we have a real dishonest interest rate environment right now. And it just kind of goes back to, hey, you got to get with your loan officer and be updating those spreadsheets and loan estimates, especially if you're looking to lock in your offering on homes.
Fantastic. I'm taking notes, when I hear things new like that. Before we jump into the next comment, I would like to go ahead, and I saw Jaji pop up another comment after that question. Jaji, thank you so much again for the question. Addie, can you reiterate how to find your podcast again? Please break it down so that Jaji or anyone else that's listening that wants to tune into your podcast can, please.
Yeah, well, definitely. Well, we can add it in the show notes, but it's MLO for Modern Loan Officer. So you can, if you're on like Apple, you can type in MLO, or you can type in Modern Loan Officer and subscribe that way. Also on Facebook, MLO, Modern Loan Officer, you can like that and see all of our episodes live streamed there. Modern Loan Officers plural.com is a direct if you're not a fan of subscribing to any platform. Some people try to stay off the grid. I try to respect that. So Modern Loan Officers plural.com, you can go ahead and directly listen to any episode. And thanks for asking.
I'll get that updated. By the way, Jaji, after the live stream, I'll make sure that I incorporate it underneath Addie's information. I already have Jesse and Bill's information is down there as well if you guys want to follow them. So everything is there for them too. So let's go ahead and, oh, Megorium, you are so funny. I love your sense of humor. So Megorium says, oh my God, the top right guy sounds a little bit like Norman Jean McDonald.
That's what I laughed at earlier, Andrew. That was hilarious.
I figured that's what you were. Megorium has a great sense of humor. She's been on my channel for, at least 2 years, and always is very lively with bringing fun to the process. So I love it. Kyle Walker did piggyback off of his questions earlier, saying our credit scores are just about 700. We got rejected for conventional because of the student loan thing, but hopefully we can pull through for FHA. Should hear back today. Awesome. So keep us posted on that. We're going to be here 3 times a week, Kyle, Monday, Wednesday, Friday at 9 a.m. Pacific time, streaming on YouTube and Facebook. So please let us know how that turns out. Nasha22 says, I trust Andrew. Thank you so much for that, Nasha. And if anybody's watching in Portland, Oregon, please definitely feel free to reach out and trust Jesse Dow and Addie Nett to help you out with any of your real estate needs there as well. And Kathy Martinelli. Kathy says, always great info here. Really worth tuning in. Thank you, Kathy, for that. And definitely please share it around on your social media to get let everybody know what's going on so we can help more people get the right information, not the fear-mongering information, because I really get very, very upset about that fear-mongering and clickbait and just misinformation, misinformation, a polite euphemism for a straight-out lie or a straight-out deceit, if we call a spade a spade. Bill, you and I were chatting the other day. I've come up with something new, or at least ways I think it's something new. And if somebody's watching either live or after the fact, you can correct me if I'm mistaken. But you like to say that every coin has 2 sides. It's a common refrain, right? Well, I tell you that every coin has 3 sides. You have one extreme on one side, you have one extreme on the other, but in the middle is often overlooked, but it's the transparent truth. So that's like my new thing, like my new ism, if you will, is every coin has 3 sides, and we got to focus on the truth because it's often overlooked. You cannot have either extreme without the truth in the middle holding everything together. But yet for some reason, without clickbait, without fear mongering, without salaciousness and deceit and misinformation, it seems like, to me, we should have like 24 million people watching this stream. And because it's so transparent, it's so honest, and we have the right professionals in, right here, right now, to get the information out there. But I don't do the fearmonger thing. I just put it out straight for what it is. And, that's why, Kathy, you say really worth tuning in. And earlier today, a gentleman letting us know that he actually sets his alarm to make sure he can join the stream 3 times a week. It's much, much appreciated. But now let's grow our community. Now let's grow our tribe and get the right information out there. And through this process, you can have the opportunity to meet other wonderful people, just like you've met Jesse today and Addie today. And then to find out that Jesse has a YouTube channel, Addie has a podcast, and this is how we can really help each other, is through honesty. And it's really about, in my humble opinion, at least, bringing love, joy, and hope to the world transparently, honestly, and making sure that we treat everybody with respect and dignity. So, Kathy, those are big passions of mine. And do remember, and please get the word out, every coin truly has 3 sides. The truth is in the middle. Don't forget that side.
The one thing I like that one of the many reasons I love Addison being on our team is because he is up every morning at 4 a.m. so that he can watch the opening bell on the New York Stock Exchange. And he gives us a daily update, but also when he notices things are starting to shift with any clients that are, on the float down boat, he contacts them immediately and lets them know if rates are starting to swing the other way. Hey, we got to lock this down now, because that could mean some people could price themselves out of closing on their house, which we saw about 2 weeks ago. When the rate swung, 180 points in one day, and people still wanted to keep risking it. So, we do have live, up-to-date information every single day, which is really nice for our borrowers.
I think that's fantastic. And let's get into the next question from Laura Acosta. Laura Acosta, thank you so much for joining us again today. Laura says, primary residence is $73,000 and rental $145,000 balances respectively. Primary home is valued at $550,000 plus. Does it make financial sense to do a cash out refinance to pay off the rental? Lending gentleman?
It depends on what your goal is, depends on where you're at in life, depends on, there's so many factors. Refinancing is totally different than buying. If you're renting, it always, most of the time makes sense to buy. If you own a home and you have it almost paid off and you have another property, there's a lot of factors that come into play with that. If you're getting ready to retire and maybe you've only got a couple years left on paying on that primary home, all of a sudden that's going to be paid off, and you have a rental property that maybe the rent is paying for all of the expenses of that house, maybe it doesn't make sense, right? But if your rate is much higher on that rental property, then you could get on a current primary. It might make sense to do so, because you might lower your monthly expenses. You might improve your cash flow to where you could take that money and go invest it elsewhere, or maybe you could just keep it in the bank. The one thing that I'm cautioning everybody on right now, because I weathered the crash, I went through all the stuff that happened in 2008, 9, 10, all that nonsense, is just don't use your home like a piggy bank. Don't refinance and pull cash out every couple of years, because the value is going to keep going up, right? Do it if you need to. In this situation, it sounds like you got to look at your current scenario, ask yourself, hey, am I retiring in the next couple of years? When is my current primary going to be paid off? And what would your potential cash flow improvement look like if you did do this? That's just kind of the way that I kind of take a look at refinances, because we're doing a lot of them right now. And it does not always make sense to do that, even though you're going to get told the opposite by most loan officers, because they just want to get paid. But you really want to take a step back and look and see, if you do it, what's going to be your end game, and kind of what are your personal financial goals. So, Addie, anything you want to add to that, man?
Yeah, really well said. And what you opened with, it really depends on your goals. And I want to dive into that without it just sounding like that's an excuse, because it is a really, really good point, because you got to understand, hey, everyone's got a different situation. It might be their situation is to reduce overhead as much as possible. That is they're dying because they just can't make these payments, right? So that's a totally different situation than someone looking at it as like, hey, I have these 3 loans. I'm going to pay X amount of interest on them every year or for the remaining terms, and they're analyzing costs to lend, essentially. So 2 different situations, and I would attack them differently. One thing that I really don't like about refinancing on lower balance is actually how much it does cost to do the refinance, which is something that people don't really think about. So $73,000 loan, we see auto loans in Vegas and in Portland for more than that. So if you're looking at that, okay, am I going to pay. The lender fees are typically around $900 to $1,600, depending on the lender, just right there. And we haven't hit title, closing, transfer, county tax. So if you're looking at $2,000 to $4,000 just in fees to restructure a $73,000 loan, I don't like that. I don't like you spending 5% to lower your interest rate. That's not a good use of money. So you want to work with your loan officer and you want to break down that 73K, that 145, build out a spreadsheet to make it sound less complicated to people that are maybe just considering a refinance. Really utilize a break even as your barometer of decision making.
Mm-hmm.
How many months, based on the lowered monthly payment, will it take for me to recoup the total cost? Really focus on that. Don't focus on the interest rate. Don't focus on this. Don't there's more meat on the bone. I'm waiting for 2.99. Focus on your break even and what makes sense to you. How long are you going to stay in the house? And how many more months do I need to carry this mortgage to break even on the restructure?
That is very powerful information, both of you gentlemen. And certainly appreciate it. So it all comes back to reasons. And it always, the question always starts with why, in the words of Simon Sinek, right? Start with why. Everything does. And the reason that I like what you were saying, both Bill and Addie there, is it also brought to mind probably something that Jesse speak on about in real estate. You also have to understand the reasons why you buy or sell a home. And I think it's particularly relevant right now with COVID-19 and everything that's taking place. And to me, it's really the same question every day of the week. Now it's just more about how do you go about doing and buying and selling a home safely, which technology is there to assist, of course. Mm-hmm. But Jesse, I'd like to get your frame of reference about the importance of a buyer or seller understanding the reasons why they wish to buy or sell and having that clarity before they begin the process. Would you like to tackle that?
Yeah, definitely. I think that, one thing Addison and I try to understand with everyone up front is, we get all the time, and I'd say it's probably like 9 out of 10 times that people always hit us up and they just assume that putting 20% down is like the best thing to do, and then we always want to understand, or they say like, oh, interest rates are 0, so it's a great time to buy, right? So, we walk through that process of trying to understand, like, one is, how much do they understand? Where are they getting their information? And then it goes into like an educational purpose, because if somebody has the goal to like just use their house as an investment purpose, say it's like for rental or, short-term investment purposes. So like say like an Airbnb or, long-term, if they just swear they're going to live in it for 30 years. So we all know the average person buys and sells every 7 to 10 years. There's going to be like just different structures and how much money they bring down to the table. And then we can look at, how that's going to affect their monthly mortgage payments. And we preach, and we're firm believers in trying to keep as much money in your pocket as possible and staying liquid, which in this specific situation is a great reason why that is very important. One, we always try to advise that they talk to their CPA or a financial planner. It blows my mind to this day still, like how many people don't. We're actually in a situation right now where we had a client tell us that they were waiting to close on their house for 60 days because they were going to do a 1030. Otherwise, they're going to have to do a 1031 on their primary. But at the end of the day, they were making 0 profit. So they were basically waiting 60 days in this COVID situation to make their move. And so I got them in touch with our 1031 attorney. He's like, no, you don't have to pay any fees because your profits are actually about 0. So that's why in my opinion, it's always best to understand why you're buying or why you're selling. So that way we can mitigate the repercussions, whether it's, taxations, whether it's getting you the best interest rate, whether it's setting you up for success in the future. Because at the end of the day, I always like to say that we tell people no way more than we tell them yes. And it's also giving them full clarity. So that way they can make the best decision for their family. Because the last thing I ever want is somebody calling me in, 12 months saying, hey, I got to sell my house because we overextended ourselves. I love the people that call me and say, hey, and this is why our review rating I think is so high, is because people always call us and say, hey, like you help put us in the best position possible. And we feel like that we are in a very comfortable environment, where Addison really likes to go and reverse engineer and just say, hey, how much can you comfortably afford to pay? And then we look at how much they can, take out as far as getting a home loan goes. Because I remember when I was like 19 years old, and I went and got a pre-approval, and this was like in 03. And I remember I was making like $10 an hour, and they said I could get a $350,000 loan. And I remember seeing the monthly mortgage was like $1,900 a month. And I'm like, I barely even make $1,900 in take home. I'm like, this is insane. Like the loan to value ratio is out of control, and that's crazy to me. So now we actually get people that say like, I want to stay under 400,000, but I want to keep my payment under $3,000. Well, we already know that that's about a $550,000 to $600,000 loan, depending how much they're putting down. And it really opens up their eyes when we go in that reverse engineering style. So at the end of the day, it's all about hearing exactly what they want to use their real estate investment or purchases for. Because I've actually also talked to a lot of my clients too about keeping their primary residence and turning it into a rental versus selling to buy another house. And they didn't even know that was an option. So when a lot of people, say like, oh yeah, real estate agents just want to get paid and this and that. Well, I prevented myself from, selling to buying, and, that's a lot of money right there that we've prevented. But at the end of the day, I'm here to help my clients make the best decision possible. And whatever that leads to, it leads to, but I just wanted to make sure that they're fully educated and I help them make that best decision forward in their specific environment.
Jesse, I really appreciate everything that you said, and I applaud it. And I love this opportunity to be live with everybody from around the country, everybody that joins in and everyone that watches, because sometimes there's a misperception about real estate agents and loan officers. And in fact, it's quite prevalent that people only want the commission or they don't really care. And I've always said the same thing: a true top performing real estate agent or mortgage loan officer cares, and they're not concerned about the commission. What they are concerned about is the client. It's like a hashtag people first, people before profit mantra. And that's what I love showing here. And Jesse, everything you said, Addie, everything that you said, every time Bill's sharing Monday and Wednesday on these live streams, people are seeing how true top performing agents and loan officers behave, think, and work, so that hopefully you start understanding as a consumer population that, hey, this is what you need. And to what Jesse was saying a moment ago with high rating reviews, it's something that I made a video about, like how to pick a loan officer and how to pick a lender. And it always does come back to something that baffles me. People will Google what they're going to eat tonight. They'll Yelp review everything, right? But then they don't Google the person that they really ought to be Googling that's going to assist them with the biggest purchase or sell in most of our lives, called real estate. It drives me back crazy. And those reviews, people, come on, let's be real. Those are hard-earned reviews, because I'm sure Jesse can attest to this. You might have like 100 clients that say, hey, we're going to give you a review, and you're lucky if you get 50 of them. Oh, yeah. Because people forget, they get busy. It's just the nature of life. And then sometimes 2-3 years later, here comes the review, because they're still thinking about, you're still in keeping in touch with them long after the sale. And now it's there. And that's how I personally have gotten to over 100 5-star reviews across the internet, is by the same thing that you shared, Jesse. And that's why I think it's so powerful, is that you focus on the client, you and Addie, just the same way that Bill and I do. You focus on the client to ensure that they're well educated, comfortable, and confident every step of the way, and making a well-informed decision that's best for them for the reasons that are important to them. And that's powerful. So I gotta, again, just applaud that. I just love today's live stream and being live with you guys. I think we're hitting so much on the nail on the head, so to speak, right? With the truth and putting it out there. And I really appreciate you gentlemen being here. So let's move on. Laura Acosta, I see that you did piggyback later and said, thank you. Yes, very thoughtful responses. I'm glad that was helpful to you, Laura. Thank you so much for being here. Megorium, I see your comment as well. You said, so grateful that your lender did everything online. Your small town local title companies are finally starting to do e-closing, which is pretty cool. That is pretty cool.
Yeah.
Then I saw some actual questions coming in down here. Motion Khan, thank you so much for being here. And no, we haven't covered it in today's live stream, Motion, but I definitely appreciate you raising it in this live stream. So this is like the 13th or 14th one that I've been doing this, and this question has come up every live stream. So as opposed to me saying the same thing again, I want to open this up to Jesse and Addie's insights. The question is, thank you and apologies if it was already discussed, not in today's live stream, but I've discussed it in every previous live stream. With all these recession rumors, is it safe as a first-time homebuyer to buy or stop until the situation settles? Are house prices expected to drop? So to get additional perspective, that's why you gentlemen are here. Please provide it.
Yeah, when Jesse, I'll open up here. So I think first and foremost, you need to consider where you're at in the country, because every market is different and reacts differently based on what are the jobs in that area, what's the price point, what are the surrounding competitive markets. So I truly can only speak to my opinion from Portland, Oregon. That's where I'm located at. So on the West Coast, the three main points, maybe four main living areas are starting north, Seattle, then Portland, San Francisco, LA. On the West Coast, Portland is the cheapest, most affordable place to live. Like the comparable sales prices aren't. I got one client who had a 1-bedroom apartment downtown San Francisco. They were renting for $3,200 a month. Came up to Portland, bought a $550,000, 2,700 square foot home, beautiful, built in the last 3 years, and went 5% down and reduced their overhead by like $650 a month. And they work remote. They don't have to be in San Francisco to do it. So I bring that example up because what happens in a recession is people look to reduce their largest overheads first, right? So if they're paying a huge mortgage in these areas, we're seeing a lot of people come to Portland for a lower cost of living. So they're going to offload their biggest asset, their home, and they're coming up to the Pacific Northwest and finding us in Portland. So in my area, am I going to see home prices drop right now? No. And I actually think that there's I was talking to Andrew about this, a false sense that people who are buying out there can get $30,000, $40,000, $50,000 off just because they're out during a pandemic to buy. No, all the people that are out there right now, from what I'm experiencing, are serious buyers and serious sellers. They're not doing it for fun. Okay. Mm-hmm. So nor are they going to price the home like it is for fun. They're being very honest. And I'm seeing a lot of honest listed prices. And there's a false sense of deals to be had. Now, what are our uncontrollables? Moving forward, like the job market, the rebounding, what's going to happen with the presidential election? There's a million unknown, uncharted waters moving forward. So could something happen right now while we've been on this live podcast that I have no idea that will affect it and really reduce home prices? Yes, quite possibly. But I'm speaking right now. I just think there's so many variables, and you have to only look at where you're at and where you're looking to buy or sell.
I think that's a great point. And just before we get over to Jesse, I wanted to go ahead and let everyone know that Bill has to jump off here in a few moments. So Bill, thank you so much for joining in. I know you got to get on as one of your responsibilities, being a sales manager of New American Funding here, to get more, speaking to Addie's point, maybe something just popped in the news and you got to get on those meetings and conference calls with corporate. So Bill, thank you for being here. Certainly appreciate you, and we'll see you back on Wednesday. All right.
Awesome. Great job with you, Andrew. Jesse, Addie, great to meet you guys.
Yeah, likewise, man.
All right. Have a good week.
Yeah. So, this is actually something that I am very passionate about. I'm actually just getting ready to shoot a video specifically on what the difference between 2008 and 2020 is, because we consistently hear it all the time that people are waiting for the next crash and, so on and so forth. Obviously, this is something that we've never gone through in the history of America. But if you look at, like, say we did get into a recession, which, we have to have multiple quarters of negative growth in America for it to be considered a recession. If you look at the history of all of our recessions over the last 100 years, the Great Depression saw a 7% value decrease in home prices, and the economists cannot figure out why it was so low. If you look at like the recession or the Great Housing Recession of 2008, it was pretty substantial. It was like 27% value decrease. Well, the reason, and then any other recession in between there was always either it was at a flat growth or it was a slight increase in growth. There was one recession where it was like a 0.5% decrease in home values. So realistically, I mean, from historical data, the home values are typically they're flat or grow a little bit unless there's some major reason why. And if you look at what has gone on in 2008 versus now, I mean, appreciation in 2008 was growing at 10% plus across the board and all in America. Plus there was an oversupply of homes the inventory rate was pretty high and it was a buyer's market for the most part, but there was so much available credit. So here's the biggest difference is that if you look at the mortgage credit index in 2006, it was sitting at about 850 points. So 100 point would be like the hardest it is to get a loan in available credit. And the higher you go, the easier it is. So in 2006, it was about 850. Today, we're sitting at 150. So right now, the guidelines are a lot tighter. So, and now our inventory is sitting at, in our market specifically, at 1.8 months of inventory. So that means if we stop listing homes today, we would be out in 1.8 months based on the absorption rate. Anything below 4 months is a seller's market, 4 to 6 is a balance, and 6 and above is a buyer's market. So we have zero inventory. And we all know that inventory supply is what drives pricing. So we're still putting houses under contract. And even when you look at last month's inventory rate versus this month, inventory in our market is specifically decreased. And that is because you still have serious buyers out there and you still have people selling homes. So there's just not this sense of urgency where people don't have the need to sell their home. Another great stat that I really like that I just read about in Keeping Current Matters is that over 53.8% of all Americans that own a home have over 50% equity in their house. This is a really, really interesting fact. And also 37% of Americans own their house outright. So free and clear, no mortgage payment, which is amazing. The thing that is important to keep in mind is that, people don't have to sell right now, or they're not overextended on their mortgage payments. What I was saying earlier, when I ask a client how much they want to feel comfortable making, this includes having reserves in the bank account. We talk about this all the time. Hey, if there's ever a rainy day, you should have X amount of dollars as a safety net, because if something like this ever happens, you're going to have your nest egg set aside to make it through hardship times. Another thing is that the government is really working hard to make sure that people are still getting paid, whether that's like through furlough, whether that's through unemployment, all these things. Everyone is working collectively together to make sure that people are still making their payments. There's forbearance programs. That's not forgiveness. You're still gonna have to make those payments. Credit card companies are working very diligently. Car industries are working hard to make sure that people can either miss a payment and make it up at another point in time. So I feel like everyone is making sure that everyone is staying protected with their mortgages. If you go 2 months without paying, you obviously go into pre-foreclosure, which then you start getting into a lot of hardships. But since there is a low inventory, and if people do need to sell, there is that exit strategy. But it's always about understanding your specific situation. And yes, will we see foreclosures from this? I imagine we will. It's just a sad situation, because I know that some people are very proud people, and they don't want to let people into their lives and understand exactly what is going on. And Addison and I had a conversation about this when this first all went down, is, hey, people are going to lose their jobs. People are going to need to sell their house, but they're going to hold on till the last minute and probably let it go into foreclosure, which is, it's just a sad situation. But when we know what the full situations are, we can prevent all that stuff from happening. So as far as a value in home prices go, I don't see it happening anytime soon. Our market right now is very stable, and we're only growing at about 1% increase for the last 3 years. So, that just indicates a very solid market with low inventory rates. It's when you see like these great ups and downs, peaks and valleys of home values growing fast, or inventories growing fast or dropping rapidly. That's when you see a volatile market. So I think our prices are going to stay pretty firm where they're at. To see a house go, say if it dropped 10% from 400,000 to 360, which would be a 10% value drop, I don't ever see it happening. And we also price houses to be sold in the first weekend, because we all know the longer the house stays on the market, the less people are going to offer. So I am seeing people come in right now and write offers with the house going on the market one day and writing $30,000 under value when the house justifies the price. And the sellers aren't desperate. They're not selling. They're not feeling that they're in a position to have to be taken advantage of. So I think that people are waiting now a little bit longer and expecting that to get the full value of their homes and close at the right price.
Yeah.
So I put a lot of it out there. It's just, I am very passionate about this topic. because people for some reason think that they're going to get a deal,
Yeah.
You know, and there are deals out there. You just got to look for them and wait, be patient, put yourself in the best position possible so that you can strike when those opportunities do come.
Well, to that end though, right? And it is important to have clarity and context on the matter. And that's why I wanted to glean your insights and perspective, because I've discussed this again and again and again. On my channel, there is a playlist. It's called Housing Market Predictions. I've been doing them since about 2016, 2017. I do a lot of research and different stats that you were mentioning a moment ago. Here's the actual 14-page outline for this year's 2020 prediction video. And when people ask, hey, is COVID going to take out the real estate market? My answer to you is a straight up no. Is the stock market going to take out the real estate market? My answer again is a straight up no. What can take out the real estate and mortgage market in totality and in reality is employment. And if employment issues arise, then at that point, we have more to be concerned about than just real estate. Real estate is the last thought. So when people say spike in foreclosure activity and everything, to the point that you mentioned a moment ago, with 57% of Americans having, I believe you said it was 50% of Americans having 40% or greater equity stake in their property, right? Mm-hmm. If you're really in between a hard knock spot and you're missing 3 mortgage payments, getting ready to kick off that notice of default situation known as a foreclosure, right? Then you would list your house and tap out, as painful as it is. Pride or not, people aren't stupid, in my humble opinion, and people would come to terms and eat crow on that, take their money, regroup, and reassess into the future. And to another point, right? This is why I like to say that, you know, my new comment here, right? Every coin has 3 sides. And in the middle resides the truth with the transparency, right? When we really get transparent about this process, and when we really start understanding all the market, what makes the market tick, TIC, right? Trends, indicators, and conditions. That's where we can bring in the totality of the situation and bring it in the context with what's truly going on here. So when we're talking about with all the recession rumors, look, recessions could hit, but back to, and I love this about Jesse, he's clearly stat oriented. And he knows what he's talking about from a factual point of view, which is cool. So from a factual point of view, Motion, when we're looking at recession rumors, okay, let's say we go in the recession tomorrow and it's the worst one ever, right? Let's just say that. Going back to historical data, real estate prices have generally not been harmed at all. And in fact, there are real estate markets like the .com era, when we had recessions in the early 2000s, that real estate actually appreciated. And to what Jesse was saying earlier, the legislation that was passed that started really tightening down, and I know lenders always love me for this when I say it, is the Dodd-Frank Act. Whenever President Obama was in office, and part of their response to the 2006-2008 debacle and collapse by implementing more regulation and lending standards into the market. So when you start looking at the differences in between the market, where borrowers now have to actually be able to afford a home through income, asset, credit, and employment verification, it's different than stated income, stated asset loans, and no income, no asset loans back in the day. So that's where we have to really get clear and really gain insight. So again, to Jesse's point, 1.9 months of available inventory in Portland, Oregon, right? Yep. So over here in Las Vegas, it's pretty darn close to the same. Then to that point, we all know as real estate practitioners and lending practitioners in this case, that's a seller's market. You're in straight up seller market territory. So what happens after the forbearance situation and the spike, this alleged spike, which I believe, again, would be incorrect, foreclosure activity? I don't think we're going to have that much foreclosure activity, because when you start going in the mortgage forbearance, let's say this is a big misnomer or a big question that's on my mind right now. Exactly what is that repayment term going to be? Is it going to be 3 months, 6 months, 12 months? Is it going to be tacked onto the backside of the loan? That's question number 1. But then question number 2 is, okay, let's go back to the statement a moment ago, right? If you were in that position and you have equity in your property, because a lot of Americans do, unless you bought in the last 12 to 18 months, there's a very high likelihood you have enough equity in your house to sell your home without having to come to a closing table with money out of pocket. You could sell, discharge, rinse, repeat, and rebuild at that point, right? So that's important to take note of as an option there. You also have this thing called mediation. With this being so prevalent with mortgage forbearance and everything going down, there will be some hardcore, intense mediation before someone gets kicked out of their darn house. Let's be honest about that. And that's not going to go into the foreclosure territory while you're in mediation of a situation, which is going to be looking for actually doing something about a repayment program that's going to keep somebody in their home. So I had a conversation with my broker here locally in Vegas who was around and had his brokerage back in the whole heyday of the 2006, 2008 collapse, and was like dominating in distressed property sales. And I said, hey, let's get the brass tacks on this. What do you think is going to happen as a result of all this? I said, I know where my head is, but I need to gain insight and perspective. So I just wanted to hear his advice. He said, look, will foreclosures go up? Maybe. In Las Vegas right now, they only account for about 1.5% of our total market. Whereas whenever I got into real estate, late 2013, distressed property sales accounted for over 55% of the market. I was cutting my teeth as a new agent on distressed property sales. And that's how I learned it. And now in 2020, it's less than 1.5% of our total available market. And that includes your short sales, your auctions, your foreclosed properties, right? So it's important to take stock of that. And I said, so what would be a worst case situation in your humble opinion of possible foreclosure activity in the Vegas marketplace? He said, maybe 4 or 5% tops. So would they go up? Yes. But were they going to go up to a portion of the market to throw the real estate price indexes? Not at all. Because they're underneath. And actually, when you start talking about 4 to 5%, and Jesse, I know you love stats, and it may have been a stat that you've already researched as well. Tell us what the average foreclosure for most markets are on a 100-year historic average. There is a built-in segment of a percentage for distressed property sales that account for overall sales across the United States. Like, for instance, last year, approximately, I want to say 16,000 homes sold per day. So when we start looking at that, what percentage?
Oh, I would say it's probably under 1%.
Currently. And what is the overall percentage across the 100-year historic average? Do you know? And if you don't, it's okay. Because
I don't know. I'm just taking a wild guess. I'd probably say it's probably about the same.
Right. So normally you're looking at averages under like 3%.
Okay.
So, under 1% is cool, but generally you're going to be like under 3% by and large for most cases, right? And the reason I think this is important is people need to understand the totality of a situation ideally. And that's why I enjoy doing this so much and especially with gentlemen like yourself, is when we look at the totality, and the reason that 2006, 2008 comes back to most of our mind's eye. Your average first-time home buyer is a millennial that is aged around 33 to 34 years old. In their life history, right? You got to look at generational history now and put it in perspective. What is a blow up in the market from their perspective? 2006, 2008, when they were much younger, right? But in reality, what is a blow up? And how often was the 2008, 2006 marketplace? And how long was it since the last time we'd seen something that dire?
Oh.
To your point, the Great Depression in 1930.
And that had
because
unemployment rate, which was crazy.
Right? Because I did the same thing. And that's why it's like, hey, you want the links, bud? Go to watch that. Go watch that video because I nerd out on it. And if you need the links or something, I can email you my Word doc with 3 pages of links that I digested to come up with a video and try to make a very simple to understand video on that.
Yeah. And I work with a lot of clients from all different spectrums. And I do have the clients that still want to buy foreclosure homes, and the banks want top dollar now. This isn't like it was in 2008 or 2009, 2010, when they were just wanting to get rid of the houses when the government gave them a bailout. Now these guys are wanting to get every last penny back. There was a house that was listed at $450. I came in and wrote an offer on it for $475 above asking. Guess what? The bank did. They rejected our offer and they said, no, we want more. And the thing was, is they wanted the net of what they owed, and they wanted the real estate fees included, which at the beginning they said they didn't care about the fees. They would eat that. So no, then their counter was $500,000. So that's a huge difference too. It's super hard to buy a foreclosure now and get any bit of a value on it.
Fantastic. So Motion, thank you again. I saw that. You said, thanks, guys. That helps tremendously. Appreciate the detailed explanation. Andrew, love all your videos. Binge watched several of them. Oh, I love you a long time if you're binge watching. Oh, yes. Bingers are good on my channel, right? You get very educated. One last thing. How is the interest rate trend like? Expected to drop? We covered at the beginning of the live stream the interest rates from both Addie and Bill Marin's perspective. Since Bill had to go, I know Addie has to go here in a few moments. What I would like to do is actually bring this to a close, so then we can let the lenders do what they got to do, and then Jesse and I get back to what we need to do. But in short, Motion, please go back to the beginning of the stream in this case and watch it so you can get the scoop without any rushed comments here at the last moment. So, gentlemen, Jesse and Addie, thank you again so much for being here today. It is fantastic to have both of you here.
Mhm.
And are there any final parting shots you'd like to leave us with before we adjourn today?
The only thing I'd like to say is, to everyone listening, whether you're in Portland, Miami, New York City, one, I hope you guys are safe out there and healthy. Two, if you are thinking about buying a home, reach out to Andrew, Addison, or myself, depending on what market you're in. Always get educated. It doesn't cost anyone any money to talk to a lender or a realtor like myself and just get educated on this fact. We get a lot of people that are scared to talk to us for some reason, I don't know, but we only get paid when the deal closes. And as far as a buyer goes, the seller pays for the real estate commissions. So get educated, talk to a professional. I'd say don't fall for the clickbaits online and just really, really put yourself in the best position moving forward, because at the end of the day, this should be the most important decision that you make of your life as far as a purchase goes. And you should be working with true professionals.
Thank you, Jesse. Addie, you have anything that you would like to share on a parting shot?
Yeah, that was really well said. I would just add, no matter where you're at and whatever team you're working with to buy or sell real estate, and I can only speak to the loan side, have a relationship with your loan officer. And if you feel like your loan officer is not giving you attention in the sense of like actually running numbers when you're putting in an offer, actually disclosing what your rate, fees, cash to close, monthly payment is, and sending that to you, find someone that will give you that attention, because we're currently in a market that you cannot afford to partner with someone that's not serious and someone that doesn't have a finger on the pulse, because there's way too much on the line. There is way too much on the line in terms of getting approved for a loan and not what it's going to cost you as a family. So just make sure you're working with some people that really take their craft seriously. I'm going to leave it. Try not to get too long-winded, but I appreciate everyone's time. I really appreciate being on here. Andrew, this was fantastic. I think we covered so much stuff and just wonderful. Thank you very much for having me.
Fantastic. And thank you for joining in. By the way, both of you gentlemen are welcome back anytime in future live streams. If you want to hop on or something, please feel free. I always make the link available in the show more description. And if I see one of you two gentlemen wanting to pop on, then we'll just put you on screen to help answer some questions as well. So thank you again so much for both of your time. To everyone, thank you for hanging out with us for an hour and a half. It's been a blast. It's been a lot of fun. And please now go out there and be the reason someone smiles and stay safe. We'll see you again on Wednesday at 9 a.m. Pacific time.
Let's get it. Have a good week.
Perfect.